and Biz Talk Today TV. Welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Mike Dickson. He is the head of research and quantitative strategies at Horizon Investments, located in Charlotte, North Carolina. Mike, welcome to the program. So, as you know, we're in the middle of earnings season. So far, an upside surprise for what we've seen so far. What are your quant patterns, or what are the quant patterns that you may be seeing right now in these earnings reports? And do you think maybe investors are just chasing momentum?
Yeah, hey, Todd, thanks for having me. Happy to join the show today. To your point, I definitely did notice we were in the middle of earnings season. It is, this is last week was a big week. This week is a big one as well. I think we still have two of the juggernauts, Google and Amazon, later this week. But, just reflecting back on last week, I think for the Mag 7 reported there, one of the things that was kind of telling to me, and one of the things that we look for is just kind of how full some of the prices are. In particular, you just take a look at Microsoft, for example, right? These are like overall at pretty solid numbers. But when you look at kind of that price reaction immediately thereafter, which was about a 10% fall, which has been relatively sticky, it does kind of tell you a little bit about what's already in the price, right? And that is that is something to pay attention to. But by and large, the earnings have been quite good. I think one of the themes that we're looking for, as we head into this year, though, is not just earnings from those top of the market, Mag 7 type names, but the rest of the market. And what I think that we've kind of already seen a little bit of this play out, because even amongst those names, Meta and Apple, for example, had pretty good responses to their earnings. And if you look among that Mag 7, they've been some of the recent Mag 7 laggards, if you will. And so you saw some reversionary dynamics, as a result. By comparison, like I mentioned, Microsoft price is pretty full. You saw that pull back a good bit on what seemingly was quite good numbers. So I think we're in this dynamic now where you have to take a look at what's already in those valuations, what's already in the price. And just because they beat earnings doesn't necessarily mean they're going to respond in a positive manner, because the market has already put a lot of that, in the valuations. And that's going to take a little bit more careful stock selection. And I think that's what's going to drive a lot of the market this year, is stock selection, and not just, hey, let me just broad base buy the top of the market and go up. And I think we've already started to see that thus far, here in earnings season.
Do you think, because you're speaking of when Microsoft released earnings last week, you saw a 10% plus drop in the stock, but the earnings, like you said, were they were great. I mean, could you
Mhm.
imagine a company like Coca-Cola having the numbers that Microsoft just came out with? So do you think that maybe in the Mag 7 stocks that there's just a little, what's the risk component, I guess, is where I'm going with this, because it does seem like a Microsoft used to trade like a utility, and now all of a sudden we're dealing with double digit losses. Is it an overreaction, or do you think this is just customary for the Mag 7 stocks?
Well, I think one of the main things that we got to look back to is, looking at earnings growth expectations. And, make no mistake, a lot of investors would actually be surprised to know during the year 2025, when we're talking about the Mag 7 or we're talking about the NASDAQ, valuations, for example, PE ratios, right, were actually down over the course of the year, not up. Right. And so that would be a surprise to many, to learn that. One of the main drivers of that, though, is, as we get into expectations, is what do analysts already expect from earnings growth. And you take the NASDAQ this year, for example, Mag 7 this year, the expectations are for roughly a 30% year over year earnings growth. Like, that is baseline. That's what's already in the price. So that means that anything that puts that at risk is going to see valuations compress. It's going to see a reaction like what we just saw with Microsoft. So again, having those valuations come down last year, but still having a healthy return for the top of the market, that does mean that the market prices have been supported by fundamentals. But at the same time, the bar for what is considered, a beat, is a lot higher than it used to be, because of a lot of this, of course, hyperscaler AI demand, and what that ultimately means, for stock prices, which is, I think, is the big theme this year. We don't need to just hear about AI capex and AI's, here. We're going to actually need to see that impact prices. And the way that happens is through increased productivity. And that's going to show up in things like, margins and operating margins and just greater overall output with the same number of hours worked. That's going to be the main theme. We're going to need to see that also dispersing itself across the economy outside of just the Mag 7 and top of the market names. And that's why, one of the big themes that we're looking for this year is to be a much more selective at the top of the market, but also for the rest of the market begin to catch up, from an earnings and price perspective than what we've seen in the past.
Okay, so it's very interesting, and I agree with everything you said. But now let's talk about the metals. So on Friday, we had a significant sell-off. The volatility has been eye-popping. We see metals are responding a bit today. Copper's up some 5%. I saw gold was up big today as well. So with that, from a quantitative standpoint, what do you, maybe even copper, going forward for the remainder of the quarter?
Yeah, and I love this topic. We sent out a note to clients on this exact topic because everybody wants to know what's going on here. It has been extraordinary. I mean, to your point, a couple numbers I'll put on that. I was looking at this data for this note. Since the end of 2024, silver's up over 300% prior to the lashing it got on Friday. So that's 300% in basically a 13-month period.
Wow.
But then what we saw on Friday in gold and silver, particularly silver, was nearly a 30% drop in a single day.
I know.
Look, I looked at my Bloomberg data series for silver goes back to 1949. Not a single day is even close to that. Not 2008, not 2020, not Black Friday, not whatever happened in the 73, 74 pullback. I mean, nothing, right? I mean, this is absolutely extraordinary to see such a stark day-over-day pullback. Another fun fact, the largest gold ETF out there, GLD, had its single largest one-day loss since its entire inception. Again, bigger than 08, bigger than 2020. So like, what's going on here? Well, I think the trade started out with, concerns around de-dollarization or the debasement trade, right? Whenever there's concerns about, hey, higher fiscal deficits, there's concerns about, higher levels of inflation as a result. There's concerns about dollar reserve status, these types of things, geopolitical risk. All of those things are going to generally see kind of a bid for gold. And then we say, well, what's silver? Well, silver is just highly volatile gold. A lot of those things to some degree, but it's a much smaller market, a lot less liquidity, tends to be quite a bit more volatile than gold. And it does have some industrial use cases, right? Well, at some point, and it's really hard to say exactly when this happened, but at some point, this trade became not about that narrative, but became about just chasing the stock, the prices higher. You really saw that inflection, I would say, right around the fourth quarter or so. I think silver made its first all-time high in 20-something years around mid-October. And then at this point, you kind of see this handoff into pure speculative frenzy to drive that price up higher. And you look at a chart, you throw any quant model at it, very clearly exploded and just kind of went parabolic around those periods of time. And that means that basically the last several months, that entire trade is just pure speculation driven, very little fundamental support. And when you get into that type of environment, you don't necessarily need bad news to make something, to see that trend break. You just need less good news, right? And what was that? We got Kevin Warsh is going to be, the new Fed chair, and perhaps he's going to have a little bit more of a hawkish view on inflation. Perhaps that's going to support the dollar a little bit more. All of these things are heavily debatable, but he's been around for a while, so he's on record saying a lot of things. This tiny bit of uncertainty, just massive lashing on the metal side of things. But look, you've seen it's quite volatile. You've seen I think both of them are up nearly 10% today. So there's definitely still a good bit of speculation built into those prices. And I think what that means is for now, you're probably going to continue to see gold and silver kind of trade right with some of these meme stocks. I mean, that is very speculative driven. The volatility still reflects that. And until that volatility comes back down even remotely close in the areas of where it was, which it's not even close, I think it'll be hard to say that that speculation has kind of been washed out. So I think for the time being, expect continued volatility on that front.
It's the new GameStop. That's what it sounds like to me.
Yeah.
So with that though, that fear of missing out though, there's still this feeling like even JP Morgan has quite an interest in silver right now. So when you see the institutional involvement and the retail involvement, does that support a quant pattern to suggest that maybe that sell-off was a one-off? Like you said, it's first time in history we've had that big of a sell-off in silver. So if that's the case, is now still a good time to be bullish with the uncertainty? We still have uncertainty with the Fed and also some geopolitical matters. So what are your thoughts?
Overall, any quant model that you throw at these price series are going to tell you that, like I was mentioning, this is a technical term, explosive unit root, like not even close to explainable by any underlying fundamentals. So it's again, it's very speculative driven at this point. I think, for something like silver, again, it's just a much, much, much smaller market than gold. And as a result, we've seen this extreme level of volatility. I don't think that this is something that you consider as part of your core allocation in your portfolio. It's just really impossible to, given the level of volatility and lack of diversification. It is put it in the complete speculative gambling money bucket. That's where that goes. Now, gold is potentially a different conversation because over the long term, you take long-term hot time horizons. I mean, gold does tend to offer some pretty solid diversification benefits, sitting alongside stocks and bonds. Though, in a note to clients, we try to outline some of these facts as well. What folks don't realize about gold is it can be and has been historically nearly as volatile as stocks. Now, it doesn't tend to move at the same time or for the same reasons, but after a big run up like this that you've seen, it becomes kind of like a really risky stock. And I think investors need to take note of that, that given the massive price moves that we've seen up, anything a quant model is going to tell you, it's still in the pure speculation kind of bucket. So I would proceed with caution when looking at those asset classes, for inclusion in portfolios, just given the extreme levels of volatility compared to what we typically see for that asset class. And before things really calm down, it's probably safest to think about this in the pure gambling bucket than to think about it as, really a stable part of a portfolio at this point.
Let's turn the page. On the Fed pick of Kevin Warsh, is there a way to have a quant model for monetary policy?
Well, that's there's I don't know how many PhDs the Fed employs, but that's effectively what they all try to do. There are a lot of models out there that numerous academic papers, which are basically quant models thrown in an academic paper. So yes, many of those, many of those, exist. I think overall, Warsh is considered to be somewhat of a pragmatist as it relates to what what the models would be telling us. He's been on record before as being somewhat of considered an inflation hawk, especially coming out of the financial crisis. I would say on the margin, maybe with him at the helm, the Fed would be a little less likely to make, kind of an inflation-induced error from the Fed's perspective. What does that mean? Well, it probably, and again, with all of the Fed independence out there that's kind of been challenged, I think he's probably a good pick to help keep that Fed independence more in check, which means more reliance on the models, less reliance on policy. Or not policy, but the administration and the pressure they're putting. There's definitely several candidates that would have been much riskier, on the side of putting that Fed independence at risk. And I think overall, Warsh is probably a good pick to preserve that. So yeah, long-winded way of saying I think the models are a little safer today than they would have been if it had been Kevin Hassett, for example. And so I am. Certainly not claiming to have any sort of expertise on the Fed models compared to the massive numbers of PhDs they have putting those together, but we all know what the inputs are. with labor data and inflation data and generally how they think. And I think it's a safe bet to say that we can rely on some of those more academic grounded ways of thinking with him at the helm. So that should in general give us a little more clarity overall, which, having the risk-free rate of interest a little less volatile than usual is, I would say, generally a good thing for asset prices overall.
So that's asset prices. That's on the equity side, and the quant models tell us. And it sounds like what you're actually insinuating is that we should see some stability, and obviously that means that translates to lower risk or a lower degree of risk, I should say.
Yeah.
But what about on the fixed income side, on the bond side? Because once we heard from the Fed last week, we actually saw long-term rates actually elevate. That's controlled by the bond market. That then also responds to the mortgage rates that we experience domestically.
Mhm.
So how do you feel on the bond side, on the fixed income side with the worst pick?
Yeah, look, I love this topic, and I think a lot of folks, get Fed-induced interest rate cuts and what's going to happen to mortgage rates backwards sometimes. The Fed controls short-term interest rates. The Fed does not have nearly that level of control over a 10-year yield or longer, right? That is going to be, as you move further and further away from this short-term Fed funds rate, which is effectively the interest rate that large banks, basically borrow and lend from each other from the Federal Reserve overnight, mind you. It doesn't get any shorter, and it doesn't get any shorter duration or higher quality than that rate. Everything downstream from that begins to include either additional credit risk or risk related to inflation and growth outlooks. And so, if we take the 10-year Treasury, like you mentioned, just for all folks out there, mortgages that we actually use to purchase our homes, these are generally very closely tied to the 10-year U.S. Treasury yield. Right. This is far removed from the Fed's short-term interest rates that they are setting at their policy meetings. And a lot of drivers of 10-year yields are going to be expectations around longer-term inflation, with higher expected longer-term inflation putting upward pressure on those interest rates. Additionally, with that longer duration profile, higher expectations for economic growth are going to put upward pressure on those longer term interest rates as well. And, quite frankly, we have the other thing to consider is we are in a global market. And what I mean by that is this is not a closed system of what's going on just in the U.S. One of the data points that we highlighted for clients just last week is what's been happening in Japan. All right, you have a Japan 10-year yield is about 2.4% as of last week. And this is substantially higher than where it was several years ago. Why do I mention that? Because we are in a global market, right? And there's currencies at play as well. And we have seen a decent bit of volatility in the US dollar. A good bit of this can be driven by what's happening in Japan. So what has been happening in Japan is they have moved away, and this is about 18 months in the making, but the Bank of Japan has moved away from basically artificially capping their interest rates because they have been in a secular period of no growth and no inflation for a very long time. And they actually do have some growth and inflation starting to pop up. And therefore, they got rid of this yield control policy. And as a result, let market prices begin to set those longer term rates. And now the Japanese 10-year is 2.4%. So a Japanese investor is better off today buying a 10-year Japanese bond than they are buying a U.S. 10-year bond and hedging that FX risk back to their own currency. That is going to have potentially impacts on U.S. rates. In fact, it's likely over time to put upward pressure on U.S. rates on the long end, this U.S. 10-year yield. Another thing I'll add is if investors have been paying attention to GDP growth recently, it's just been gangbusters. We got a couple quarters in a row of over 4% GDP growth. The Atlanta Fed's GDP Now forecast, which basically is a current prediction of where GDP growth is expected to be for this quarter, is also quite high. So we have Japanese yields high for structural reasons, putting upward pressure on the U.S. 10-year yield. We have very high expectations for and realized economic growth here in the U.S. Look, I think this is a recipe for the U.S. 10-year yield where it sits is probably about right. If not, maybe it should be a little bit higher. All right. That I didn't even say anything about Warsh yet. That's what controls the 10-year yield. Then if you take into the account that Warsh on average or general expectations is probably less likely to cut rates to zero and more likely to keep them higher because of inflation concerns, I don't see the 10-year yield moving down a whole lot right now. And that does have implication for mortgage rates. So long-winded way of saying global markets, a lot of moving parts, but I think we're probably about right on the 10-year.
That's a brilliant analysis right there. Very well said. So, final question for you, Mike. This is the most serious question of all. Is there a quant model that's going to tell us who's going to win the Super Bowl on Sunday?
Well, again, there have been, and look, I love that question because I know it's kind of a joke, but joking question. But realistically, those guys have excellent models. If you've ever seen all the probability for winning that they pop up. So no, not my quant models necessarily, but there are some really good models out there. The problem is that these model results are generally published. You can go on your favorite website and kind of see what the probability of winning is. So just like my analogy with earnings expectations for the Mag 7 being 30% year over year, the expectation is set by publishing the results of these models. So what's in the price? Well, it's what those quant models are saying. So that kind of neutralizes everything again for us. So not a great, not a lot of great insight, unfortunately.
No, that's great. That's a great answer. So that's awesome. Mike, thank you so much. This was extremely educational. I know the audience is going to get a lot out of it, and definitely would love to have you back on the Money Path.
Great. Well, thanks for having me. Great conversation. Thanks a lot.
Thank you, Mike. So on behalf of Mike Dickson, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Coming up tomorrow, Jose Torres on the Torres Report and Jay Hatfield. He's going to break down the recent Warsh pick, and you definitely want to hear what he has to say. So until then, take care. All right, Mike, that was great.